Welcome to Mastering DCF Valuation. In the next few minutes, we will explore the discounted cash flow methodology and how it helps us determine what a business is truly worth. This is the gold standard of valuation techniques. Let us begin. We start with the fundamental concepts behind discounted cash flow analysis and why it remains the most rigorous valuation method. Before building a DCF model, we need to understand the key concepts that form its foundation. Free cash flow is the lifeblood of DCF analysis, representing the actual cash a business generates after all operating expenses and investments. WACC represents the minimum return a company must earn to satisfy both its debt holders and equity investors. Terminal value often accounts for 60 to 80% of the total enterprise value, making its estimation critical. The discount rate reflects the time value of money and the risk associated with the expected cash flows. Enterprise value gives us the complete picture of what the entire business is worth to all stakeholders. Now let us walk through the step-by-step process of building a robust DCF valuation model. A DCF valuation follows a logical sequence from projecting cash flows to arriving at a per-share value. We begin by projecting the company's free cash flows based on revenue growth assumptions and margin expectations. We calculate WACC by blending the cost of equity and cost of debt weighted by the company's capital structure. We estimate terminal value using either the perpetuity growth method or the exit multiple approach. We discount each projected cash flow and the terminal value back to today using the WACC. Finally, we sum the present values, subtract net debt, and divide by shares outstanding to get the per-share value. Sensitivity analysis helps us understand how changes in key assumptions affect the final valuation. Small changes in revenue growth assumptions can dramatically shift the projected cash flows and final valuation. A higher WACC reduces the present value of future cash flows, while a lower WACC increases it significantly. Because terminal value represents such a large portion, even half a percentage point change has an outsized effect. Margin assumptions directly determine how much of every revenue dollar converts into free cash flow. While DCF is powerful, it is important to understand how it compares to relative valuation methods. DCF gives us an intrinsic value based on the company's own fundamentals, independent of what the market thinks today. Comparable analysis shows what the market currently pays for similar businesses, serving as a valuable cross-check. Even experienced analysts make mistakes in DCF modeling. Here are the most common pitfalls we should avoid. We must ground our growth assumptions in historical trends, industry data, and realistic market conditions. The terminal growth rate should never exceed the long-term GDP growth rate, or we get unrealistic valuations. Changes in working capital directly affect cash flow and must be carefully modeled to reflect reality. A single-point estimate is never enough. We should always present a range of values under different scenarios. Let us recap the essential insights from our exploration of DCF valuation. At its core, DCF answers the question of what a stream of future cash flows is worth in today's dollars. Getting these two inputs right is critical because small changes can lead to dramatically different valuations. Professional analysts always show how the valuation changes under different assumptions to build credibility. Combining intrinsic and relative valuation gives us the most complete and defensible view of a company's worth. If this preview intrigued you, the full Udemy course walks through complete DCF models with real-world examples, Excel templates, and advanced techniques. Enroll today and master the art of business valuation. Thank you for watching. We look forward to seeing you in the full course. Until then, remember that every great investment starts with a solid valuation.